Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, July the 6th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters, I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on. Not a whole lot of economic data across the pond. We did get European retail PMI came in line with expectations, and German factory orders came in lower than expected, came in at 1%, was expected to be 1.9%. Here in the United States, we got a little bit of a precursor to the non-farm payrolls, which comes out on Friday, but this was in the form of the ADP non-farm payrolls. That came in at 158,000, expected to be 184,000. So those payrolls lower than what was expected, not good, and they revised last month's number down from 256,000 down to 230,000. So much worse than expected there. It doesn't always jive with the non-farm payrolls that comes out on Friday, but it very well could be, especially with that revision downward in that ADP number. Then we also got unemployment claims, came in at 248,000, expected to be 243,000. So more people claiming unemployment, not that good. That's probably coinciding with the lack of hiring going on in the non-farm payrolls. Then we also got the the ISM, Institute for Supply Management Non-Manufacturing. That's basically the service sector PMI, Purchasing Managers Index, came in better than expected at 57.4, expected to be 56.5. And then finally, we got crude oil inventory, supposed to be a drawdown of about 2.4 million barrels, and it was a drawdown of 6.3 million barrels. And obviously seeing that show up in the market today, any positive news for crude oil has a tendency to make that jump in a sense. So bulls taking full advantage of that much bigger than expected drawdown in crude oil inventories. So having that out of the way, like I mentioned, crude oil moving higher, up over $1. Yesterday started getting that bit of a rally late in the day, but today right back to that value area, point of control. It's going to be a big battle to try and see if they can get back through this 50% Fibonacci level. You can see that it's acted as support and now acting as resistance. Plus it's kind of got one thing going for it. It's gotten through that 50-day moving average to the upside. So bulls are going to be really trying to get through those two areas. Bears obviously want to defend that. There's still a lot of oil out there, but that drawdown is going to be a silver lining for the bulls. We got gold up slightly on the day, but as you can tell, pretty big candle for the most part. And remember, this has to do with the overnight session. The way that candle kind of sets up doesn't always make it look like it should, in a sense, because it shows those extended hours. So if we click that off, you can see that it is up on the day, but down from where it opened higher and traded lower in gold futures. So that candle has a tendency to look a little bit funny because the overnight session makes it look a little bit worse even yet, but opened higher and has consistently sold off as the overall equities are doing rather well. We got bonds finally relenting and coming off. That's helping my TLT position finally looking like it's coming back into the black, if you will. It's been in red numbers for the most part as I've ridden up that rally, and now it's coming back. The timing is looking pretty good, with the timing coming back into closer to expiration. I'm going to get a lot more theta decay, and that trade should start working out rather nicely. NASDAQ down 27 points on the day after yesterday's big rally, but well off its lows, basically taking back most of the lows that we've seen since the opening. And then we've got the E-mini S&Ps off a little bit. Feels like equities are higher, actually, just by looking at my portfolio. It felt like equities were much higher than this. I haven't really looked in a few minutes, but anyway, the E-mini S&P is down by 9-10 points, but as you can see, they're well off their lows. Off of those ADP numbers, the market really got slammed, and then the overall comeback is happening now. Anyway, on to a few things that I've done. Verizon, we've got this big drop here today. So these are a couple of things that I'm working on getting out of. And if you remember, in Verizon, I have on a July 47.42 put spread in there. It's a long put spread, and I originally paid right around, it's $5 wide, so I paid right around $2.50. I can't remember the exact number, but it's very close to that. Trying to get out of it right now for about $3.50. It's not quite exactly the 50%, the width of my strike, or 50% my max profit. Since I paid $2.50, my profit's $2.50. So I would expect to take about $1.25, which would mean I'd get out at about $3.75. But the big drop here, kind of gapping down rather quickly, and it's hitting a 52-week low here, which I did expect to see. But that gap down, I'm going to be looking to take a little bit less for that trade just to get out of it. But working it right now at $3.50, it's about 30 cents away. So not looking like I'm going to get that really anytime soon. And then in Apple, I'm also looking to cover my July trade in here. And then I have on the July 149, 142 put spread in there. And again, another, it's a $7 wide, so paid right around $3.50. So getting out of that a little bit better than $5 would be that 50% of max profit. But as you can see, it's really coming up against this support level. It's right there at the point of control for the time, where the most time's been spent. That's not where the volume's been spent, it's where the time's been spent. So people aren't really accepting price up here necessarily with their money, more so with their mouth. So this is holding up right there, but I'm looking to get out of it because it just looks like it's kind of really found a solid support right here. So working that trade as well, but not being super aggressive with it. Then on to Starbucks. Now Starbucks, I ended up covering this trade, got the nice move down. It was right there at around 50% of my max profit on that trade because I had on the August, was short the I was long the 62.5 puts and short the 57.5 puts. So $5 wide there. Paid about $2.40, I think it was 46 cents. But right there, 50% the width of the strikes, which is in line with my rules, and covered that for $3.62. So that's right in line with that as well. It was really close. Slightly lower than that. I think it was like, when I figured out the math, it was really close to $3.69, but for a couple of pennies in the way that that chart kind of came down there. I was working it right there at the 50% of the max profit, but it came down off of that 200-day moving average and started moving higher, and just decided to pull the ripcord on it because just the way that doji looks like it could have found a little bit of at least a temporary bottom and going into expiration. I don't want to risk it anymore with some kind of funky move to the upside in Starbucks, despite the fact that in August, when we're coming into that July, same wonky things can happen where people are going to try and push to their prices. So I just wanted to get out of that one. Now in Tesla, I wanted to free up some margin, so basically covered my Costco trade for a scratch. I'm not really convinced that Costco is going to move any higher anytime soon. But yesterday I was looking at this trade. I saw Goldman Sachs coming out and lowering their guidance again on Tesla. Saw some news out today as well on the Model S, or just basically in general, their sales not doing very well. But Goldman Sachs has a price target of like 190. I don't know that it's going to get down that low, but if we get below this value area, we could easily start seeing some of these other nodes happening, you know, like the 275 or something like that. So that would be the next stop if we break below this volume node that we're currently at. So having said that, I went in there into the September and bought the 340 puts and then sold the 290 puts to define that risk. Got 50% of my max, or 50% the width by a couple of pennies. Paid $25.25 for it, so slightly off. You know, it's $50 wide. It should be looking at $25, but with that much of a credit, who's counting pennies, right? So you want the penny or you want the trade, as we used to say on the floor, and I wanted the trade, not the pennies. So looking for that to pull back down below the value area. If we can get a bit of a push there, that'll be quite nice, especially in the next couple of days. That would be nice. I can easily see it go down and start hitting these nodes on the way down. So added that to my margin account. And then in Costco, like I mentioned, I covered this Costco. Actually, not convicted of it, needed to free up some margin. So this was taking up a lot of margin for me. And in Costco, I was short the July 155 puts in there, and originally sold them for like 98 cents, bought them back for 97 cents. So made a penny, scratch for all intents and purposes there. And then finally, I covered the Costco also in my margin account. Left on, I got out of the 155 puts, but if you remember, I had to put that on as a spread. So I originally in this one had on the July and was long the short the 155 puts, and then long the 123 puts to define that risk, just to kind of hold off on some of that margin there as well. So I just covered those 155 puts for $1.04, and I still have on those 123 puts for basically nothing. So if anything crazy happens in Costco, I still have that on as well. And then in also in my margin account with XLK, if you remember this, you know, those defining that risk on this on the call side with the XLK, I just left on those long calls to define the risk, and I was short the 56 calls in there, and the 52 calls are basically worthless. Nobody's trading them for 2 pennies. I just left them on and bought this strategy back for 15 cents, where I originally sold it for about 31. So 50% of my max profit on that trade. I have those calls on for free. I'm just going to let that ride. I don't really foresee that coming into fruition, but when you have them on for free, there's no sense in really having to worry about it. All right, that's all I got for you guys today. I'm going to go into the details on a lot of these call spreads. I know I kind of went over a lot of it really fast. We only have about 10 minutes to go over all this stuff, but I'm going to go over the rules as to how to set those call spreads up, the long call spreads, the long put spreads in the next couple of webinars. And then I'm going to talk about it a little more in detail as to how to set that up in an IRA, in a sense, to make it more synthetically short. So, and how we trade out of those, kind of have those calls on for free when you have the long call on. So, all right, that's about all I got for you guys today. Go to ProTraderStrategies.com, sign up for those webinars, and if you can't take that, take it easy.